Consulting, and welcome to Charts of the Week for August 24th, 2020. Please see our disclaimer for important information. As we start our chart pack for the week, we return to our COVID tracker, which we have included in the package for the last several weeks. You can see in the blue line here that the trend continues to be positive in the 7-day moving average for daily new positives, and also the kind of that orange amber line there, if you will, for 7-day moving average for daily deaths. While it looks fairly flat, you can kind of see at the very end as we approach that last data point, which is through August 19th, that it looks like it's continuing to attenuate and perhaps go down a little bit, which is all very positive news. So I thought I'd do a couple things here with this chart. One, include something that comes to us from worldometers.info, as well as the CDC, kind of comparing the coronavirus in terms of the deaths per million people in the U.S., just kind of give a relative sense of where the 2020 coronavirus shows up against some of the other notable pandemics that we've seen, during the last 100 years, and obviously the 1918 flu was extremely deadly in terms of deaths per million. It basically circled the globe twice, within a span of really about a year and a half. But where coronavirus does fit in fairly well is the 1957-58 H2N2, as well as the 1968 pandemic, and much higher than what we saw back in the swine flu of 2009. And the bottom one is something that's compiled by the New York Times. I think we included it perhaps last week, but of all of the rhetoric surrounding the development of a vaccine, this kind of gives you an idea of what that pipeline really looks like. So 135 vaccines not yet in human trials, going down to testing, safety, and dosage levels. You've got 20, so obviously that pipeline is going to narrow considerably as you go from left to right, but vaccines and expanded safety trials going to large-scale efficacy tests, and then 2 vaccines have been approved, but one of those happens to be the Russian claimed virus, which is frankly not even in most other countries wouldn't even have been approved to go into phase 2 trials based on the testing sampling that they were doing. But in any case, there's a lot of good science being put to work right now. Obviously, a lot of people are in a big hurry to find the vaccine that's going to work, but clearly there's while there's a lot of work going on, there's a lot of work that needs to take place, and a lot of testing and observation that needs to happen before anybody can really claim victory in this. This is a chart from the Census Bureau that really got my attention. Looking at it, it's basically a schedule of percent of adults with children by age group who are not working because of COVID-related child care issues. And when you think about this, and with the backdrop of the labor market having been dislocated as it was, and continues to be to a large extent, especially amongst small businesses, you can see here the profound impact that COVID-19 has had on the labor force. And basically, if you look at this chart, it tells you in that cohort of people in that green, that the people that are in their prime childbearing years, if you will, ages 25 to 44, that almost a quarter of them, 24.4% of that age group with children, are not working due to COVID-19 related child care issues. Fairly profound. So we've been spending a lot of time talking about how much money the government's been spending, and I just thought it'd be interesting to kind of get back and look at some of the data in kind of visual form to kind of give people the perspective of just how pronounced and profound this year has been. So if you look at the left, this is the government spending as a percent of GDP, and you can see clearly that we are getting back and approaching levels close to World War II. You can see the global financial crisis there in that little circle in 2000, basically 2008, 2000, maybe the beginning of 2009. And we thought the government was really opening up the checkbook back then, but that really pales in comparison with what has gone on this year. And not too surprisingly, as you kind of scroll to the right, that chart just gives you an annual fiscal deficit as a percent of GDP, and you can see there that having spiked up close to um, basically about 38% of GDP on government spending, that's going to translate into somewhere close to about a 27% fiscal deficit, which again kind of mirrors the levels that we saw only back in World War II. So, when you think about 2020, you're going to remember that this was a year of fiscal dislocation that was almost unparalleled in at least my generation, and dates back well before then. Thought I'd get back to some basic economic charts, give us a little bit of visual description of what's going on, kind of the broader economy. We've got several different pages of charts to kind of go through, and something we spent a lot of time on over the last several years is the index of leading economic indicators, which is on the left-hand side. That's published by the Conference Board. You can see, the early data points when COVID became an issue. We have the government-induced shutdowns where those numbers were significantly negative, and they were beginning to roll over just a little bit even as we were heading into the new year. And we were a little bit concerned about that relative to the stock market having, continued to reach new highs. And so we were spending a lot of time watching that. Obviously dropped significantly with the shutdowns and has battled back. And the latest data point is up 1.4%. Now this is an index, so it's a relative term, but it's positive in the sense that we have, better economic growth, and we've had several data points now of positive readings, which is helpful, even though they're less positive. And that's a good segue into the chart on the right, which is the Economic Expectations Index, which has certainly rebounded off its low. It's well below the pre-pandemic levels, and I think importantly, what we're seeing is just a slight downtick in that index, kind of giving us a little bit of pause on our enthusiasm for the third quarter economic data. And so we see basically a rolling over slightly, even though still positive, leading index number, and also a slight rolling over in the expectations index. We also see a rolling over to some degree of the consumer comfort index, and there's a lot of things that go into this index. But again, it's just an indication of how the consumer feels heading into the fall. And so obviously we battled back. There's a little bit of dislocation when we had some of the second wave, if you will, of infections that got people unnerved and caused some states to roll back some of the economic openings. But so that number has rolled over. So and it's rolled over for a couple of weeks now. So we definitely want to continue to watch this and hope that that decline kind of attenuates and levels off and perhaps goes back up. On the right-hand side, you can see basically the senior lending officer surveys, which show you this is not necessarily bank loans, but this is really more credit cards. So you can see that for those of you out there that have high card balances, obviously the banks are getting a lot tighter on credit card debt, and they're anticipating a huge spike in charge-off rates, which really have not manifested themselves yet, but the banks are getting prepared and they're tightening their standards, and I would anticipate that people with high balances on cards are going to see a noticeable jump in their crediting interest rate heading into 2021. This is a chart on mortgages and kind of the health of the mortgage market. And we know that there have been a lot of residential homeowners that have have struggled with their mortgage based on layoffs, based on small business income going down, so on and so forth. There's a whole litany of reasons why there's a faction of homeowners out there that are really struggling. And so what this chart shows us from the Mortgage Bankers Association is a delinquency rate as a percent of total loans. And we can see that that is spiked. And we haven't seen these levels since the great financial crisis. In fact, we were seeing a very strong credit trend for many, many years with just a slight hiccup there in 2017 and beginning of 2018. And we know that there was some other things going on around that time. So a spike, but then a continued downtrend globally until we hit the pandemic. And so that number is about 8.2%. So again, the health of the consumer as manifested in their ability to pay their mortgage is something that bears significant scrutiny heading into the fall. We also spend some time talking about these high frequency numbers, and there's a couple of these numbers that we get on a high frequency basis. Notably freight expenditures as well as rail traffic. Both those cases we're seeing positive trends. It's a wonderful development. We obviously hit a low and really had some problems in that area earlier, but they continue to battle back for the most part. We're still below year ago levels, but the good news is that we're seeing less negative trends here. We're seeing more rail traffic and freight going out, which is very positive for the economy. Also, some more high frequency numbers, gasoline supply, which is something we track on a weekly basis. You can see that we're still below the trend and the range from 2004 to 2019. We're not out of that range by much right now. We really came back in May and June, and then obviously with everything else just kind of hitting some speed bumps here in July with the rise in cases and some of the additional concerns that kind of came to the fore. The gasoline supply has kind of flatlined, but we're not too far off that range, and so that's another good sign. On the right-hand side, there's a lot of different reasons that are going into this. Obviously, you have the procurement and processing of raw timber into lumber and getting that into the retail channel, and then you've got a whole lot of people that are stay-at-home, kind of doing it yourselfers, and people building decks and things like that. So you have some choke points in the supply system coupled with an increase in demand for lumber, and you're seeing a rather strong spike in prices for lumber right now. So we want to talk a little bit now about the stock market. I've been saying for a while that we've had some challenges with the market leadership, and this is a slide that kind of gives us a little bit of visibility. Now, that's not to say that stocks aren't going up in total. I think that it would be fair to say that not all companies are doing very well. There's still a lot of small cap companies that aren't frankly making any money. The S&P 500 does a pretty good job of capturing basically the breadth of the economy, if you will. It represents a fairly meaningful amount of the employment of the country. It represents, from an industry standpoint, a fairly broad swath of corporate America or the business climate in America. But in this chart, what it tells us, and you see in the blue line is the index, and that's been continuing to move higher. But in the white line, that shows you, the better would be the bars here that would show you the number or the percentage of the S&P 500 members that are hitting their new 52-week highs. And that's on the left-hand scale. And so what it tells you is that basically only about 6% of the index, even though the index is shooting through the moon, only 6% of the index is making new highs. So that tells you that you have some limitations on your market leadership right there. And if you go back into late 2019 and 2020, when the market had set its previous high, which is now being challenged, you can see that there was much broader participation in terms of the percentage of S&P 500 constituents that were making their new high. So another chart that kind of talks about that market leadership, that tech and healthcare now as a percent of the S&P 500 market cap is over 50%. This is a trend that is not, it certainly hasn't happened overnight. You can see here that that there's been an uptrend since roughly about 2008, 2009, and then as we hit this latest decade, this past decade, I should say, 2020 marks the dawn of a new decade. But over the last decade, that number has been continuing higher, and you can see here in 2020 with this leadership that it's really just spiked higher. So we've got health and technology that have really taken broad leadership of this index. From a global perspective, we can see that there's an increasing risk-off attitude. That index is not beginning, but it's clearly rolled over here in August to date after being fairly robust, and we've had some rises in caseload in certain countries, and we've had some additional hiccups from an economic standpoint now in other areas of the world. But really up until about the middle of this month, up until basically last week, the global risk on trade was well underway, and so we see a little bit of rolling over in that right now. So we're going to talk a little bit about the dollar and trade, and then we'll get into China. Been some comments this week from folks wanting to get an update on China, but here we've talked about the dollar a little bit, but the rhetoric is that the dollar is losing steam, and there's some concerns that the dollar may cease at some point to become the global reserve currency, and I think those notions are fairly far-fetched at this point. In fact, the last time that the reserve currency change was basically back in the 20s when the dollar took leadership from the pound after World War I. But and it was really more emphasized after World War II and the Bretton Woods Agreement. But enough of that. I'd just say that in the left-hand chart it shows you the ebbs and flows of the trade-weighted dollar, which is an important dollar. It's an important way to look at the dollar, but you can see it actually strengthened into the last few years, and for all of the rhetoric about the dollar having rolled over from a trade weighted basis, it did roll over during the pandemic, but not as much as people would think. And you can see that depicted. You can see that leg down, if you will, underneath the word COVID on that chart. But if you go on the right-hand side, you can see the Chinese yuan has definitely appreciated. And for many, many years, the Chinese government has sought to peg the yuan to the dollar. And that's obviously not the case right now. As you can see, the cost in dollars to acquire one Chinese yuan has gone to back up to 6.9. So Chinese yuan clearly getting more expensive. So more data from China, just getting into this and the rhetoric. So, interestingly enough, that we've had a fairly strong increase in Chinese productive capacity, and this is not just kind of a recovery. Well, it is, but it's also a strategic play by China to increase their productivity and production. And this chart kind of measures that in terms of industry value added year over year, but consumption has been muted. So interestingly enough, so you've got a consuming public that would typically import goods from the U.S., especially at a time where the dollar is maybe weaker against the yuan. That's not happening. So production is more geared towards their export machine. So more exports, fewer imports. And then you can see on the right-hand side that of those exports and production that's underway, that the producer prices year over year are going down. And that typically does not bode well for small cap stocks that find it more competitively challenging to go up against Chinese products, even at a time where the yuan may be higher against the dollar, because these producer prices are going down so precipitously. So it's a very interesting dynamic right now, but it doesn't lay the groundwork for a very strong recovery in small caps. Our trade balance, as you can see, was getting significantly worse. And then when President Trump and the administration drew the red line on trade, you can see how that reversed dramatically. And then now it's actually kind of gotten worse again after the pandemic, which is ironic because of all of the negative rhetoric. We've actually increased our trade deficit with China. And a lot of that has to do with healthcare products and essential medicines and things like that. So I'd say that a lot of that left-hand side, that leg down in the trade deficit has been a result of healthcare imports from China. But on the right-hand side, you can see exports to China by category and total goods. And so, there are targets that were established in both the agreements. There's expectations that were built into a lot of Wall Street analysis. As you can see that, right now, as of the first half of 2020, that the actual exports to China are falling well below those expectations, and so we'll have to monitor that. And in our final chart of the week, we take a quick look at the Postal Service. Oh my goodness, I can't tell you how many articles I have seen talking about the Postal Service and all of this hubbub back and forth. What's clear is that the Postal Service is not a moneymaker. It's supposed to be self-sufficient, but it's from its package delivery standpoint, it competes fairly heavily with UPS and FedEx and all of the folks that are doing ground and overnight and priority mail. And so, the deficit this year is about 8.8 billion. And, frankly, the Postal Service hasn't made any money since almost at the beginning of this century. So nothing new there. And kind of a slightly humorous note, I found this chart that's that kind of pegged the worst U.S. cities for dog attacks on postal workers. And obviously, if you're a postal worker and you've been attacked by a dog, it can't be very much of a fun thing. But in any case, I'm not necessarily proud to say that Houston and Dallas both rank high on the number of dog attacks on postal workers. But anyway, if there's data for everything, and this will be important to some, I'm sure. So anyway, there you go. Well, that will do it for Charts of the Week for August 24th of 2020. Please feel free to reach out to us at the information you see on your screen. We'd love to field your questions. Have a safe week, a good week, and we look forward to seeing you this time again next week. Take care.